Hi, my name's Elisa Di Marco, a Portfolio Manager at Magellan Asset Management.
Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Elisa, welcome onto the Australian Finance Podcast today.
Thanks very much for having me, Kate. Great to be here.
And thanks for coming to our studio in Sydney. It's fun to record some episodes up here for a change.
No, it's a great studio that you've got, so looking forward to our chat.
What does a day in a life look like for you as a fund manager?
Yeah, so in funds management, the role is multifaceted. So we're interested in what's happened in the markets. It's what's happened to the portfolio. We're engaging with our clients, but then also working with our investment team on how we're thinking about the investment philosophy. So in terms of like the direction of the day and what it looks like, I think most of us would always start with, well, what's happening in markets? Because markets are such an important part of being a fund manager. It can impact not just the performance, but then also that long-term thinking of, well, is this a quality company? It's starting the day looking at emails, blogs, and it goes from there. But
reading the AFR over breakfast?
Magellan, we're focused on global companies. So what we get the benefit of is just getting the whole spectrum of global news from opening to close. From when we wake up, we're not watching the market live. I really enjoy my sleep. So
that's good. I feel like people's sort of mental image of a fund manager is probably someone that's just staring at their computer at what the stock market is doing at any second.
Well, our traders have that image, that 6-screen virtual, which has got all of the trading picks and live happenings. But I'd say for the more research analyst side of things, we do a lot of reading. Of course, we do have our the stock charts that we're looking at, but a big part of our day is discussing our view on the market and how that could be impacting the future of our companies, the industries that they play in, and then the outcome on the portfolio.
Sounds pretty serious. Do you have any fun?
I love it.
Yeah?
Yeah.
You love being curious about companies and what's going on in the world?
Oh, yeah, absolutely. I think that's something that that's what I think is the draw card to funds management. And I think a lot of people often forget because it's that kind of what you've seen in Hollywood is not really a reflection of our day-to-day lives. It's not near as sexy as Hollywood, I think, is portraying it.
Not Wolf of Wall Street.
No, not Wolf of Wall Street. But I suppose we just find it really interesting. Like we get to read and to learn, which is just an extension of our days at school.
And how did you end up specifically in funds management? Tell me a little bit about your journey along there.
Yeah, so I was always good at maths. And then when I got to high school, started studying economics. So definitely had the right kind of foundation in terms of the subjects I enjoyed and the way my brain was thinking. But I think the translation and why I really like that kind of inner working of companies and how it fits into the macro is that my family always owned a lot of different small businesses. And then I was working in one of the restaurants that we had. And so you're always kind of just talking about the ups and downs of the business and the success and what needed to change. And so that translated to the dinner table and talking about the economy and companies. So it's a really nice kind of adjunct that now, like, my job is to kind of interrogate companies and see how they fit into the industry.
It's always so interesting how people's money story plays into where they are today. And that's really fascinating working in a small business. Are there any other insights that you think you've gained from working in that small family business environment that are helping you today?
I think the main one would be just being able to talk to people, because you need to have a confidence when you're working in a restaurant. You're talking to all different clients and interacting. And so when you do that from a young age, I think that's a really important skill, just to build confidence in what you're doing. And then it's also that just resilience, and working in restaurants, it's really fast paced. You've got to multitask. And I think in life, if you're able to multitask and just kind of keep working on one project while something else is boiling in the background, pasta or whatever it may be, I think it's a really important skill.
Yeah, it's interesting to hear that, because I'm sure many listeners have had that experience of working in retail or hospitality or something like that, and probably wonder how those skills might be applicable to investing. So even just hearing that, the conversation aspect is really important, because part of what your job is just to ask questions.
Yeah. No, absolutely. Really good point, Kate.
Do you have a lot of conversations with the companies that you're looking to invest in on a day-to-day basis?
Yeah, absolutely. It's a big focus at Magellan, is the engagement side of our role. And there's really two reasons for that. One is to better understand the risks and opportunities of that company, but then also to potentially influence that company to drive those superior long-term outcomes. We actually spoke to a company this morning. So the end of the day in the US is bright and early.
So you're hustling on the way to the studio.
That's right. And so it's an out-of-cycle annual general meeting, and we do like to talk to our companies to help inform our voting to better understand their perspective before we execute our votes. Just one example. So that was a call we had this morning, but we're always talking to our companies to better understand what the opportunities and risks are.
You mentioned voting there, because I think that's something that often we forget as shareholders of individual companies, that we have the opportunity to vote on issues there. So do you take quite an active approach there? Yeah, no, we have a really active approach to our stewardship. So that is that engagement to influence, but then also our proxy voting process. So we do all of that in-house. We have our ESG team that leads it, but then we're really working with our investment team, because they're the ones that know the companies inside out. What is the right metric to drive long-term growth? Our analysts know that better than what the ESG team could be potentially influencing them. So we do all of that internally, and it's a really important role that we have as active managers, and the role that our vote can have, because we are trying to drive that positive influence and positive change in the company, and your vote is a way that you're able to do that. So thinking from a retail investor point of view, where I might only have $1,000 invested in a company, do you think it's still worth me paying attention and voting? Can I have any sway? Look, it's all about the number of shares it does come down to, because it's the majority that will lead to your say. But just like your voting counts in politics, it does count when you're voting for companies as well. So I would really encourage everyone to pay attention to those annual general meetings. And the good thing about it is that you can really get to know your companies better, which then will give you more confidence in your investment thesis, be that to maintain your holding or to potentially sell. Because governance is such an important part in investing, in having confidence in management and how they're able to continue to invest the earnings that they're your earnings essentially. So you want to have conviction in your management team. Absolutely. And as a side note for anyone listening, we've been doing some work with the Australian Shareholders Association, and they provide some great insights there on how to actually research when a company puts an issue up for vote and what their perspectives are. So that might be a helpful resource if anyone's interested. Now, what I'm also interested in learning about is why you chose to go down an active investing path. Many of our listeners are passive investors. They're investing in ETFs. They're building up a core portfolio. What led you down the more active side of investing? Yeah, so I think it really is. So in index investing, you get the whole market. So that can be the winners and then the laggards. And it's really interesting stat this year that like the majority of strength of markets this year has really been driven by what we call the Magnificent Seven out of the S&P 500. The remainder of the universe hasn't done that well this year. So when you're doing index investing, you're going to get the market return with certainty, the winners plus the losers. But in active investing, the way that Magellan approaches it is that we do this deep fundamental research. We're looking for those companies that can generate sustainable excess returns into the future for decades to come. So that's our definition of what a winner is, a company that can keep
keep generating really strong returns. So that's really why we're focused on active investing and the role that active investing plays within your portfolio, because we're looking to really beat the market over the long term, because we're picking these companies that will be around for decades.
Many of us have heard that we can't usually outperform the market. We won't just be able to pick winners. What helps you and the team at Magellan find those companies that are going to outperform the rest?
Yeah, I think that really comes down to our investment philosophy. Now, I've been at Magellan for over 8 years, and when I started, I was like, okay, these guys have a really different approach to working out, well, what could we invest in? And that's our approved universe. And that really is that definition of quality. So what we're looking for is not just a particular ratio, what's the company done in the past. We're looking at, well, how can this company keep generating really strong returns into the future? And so that is it's easier to say than actually do, right? You're trying to have this crystal ball, which none of us have. But what we do is deep research and collaborating and understanding, well, what makes a quality company. So we're looking for competitive advantages. Does the brand have, does it have a brand? Does it have scale advantages, barriers to entry, network effects? All of these attributes will protect the economic moat, their ability to generate excess returns into the future. And it's not just looking at it once, it is just continually monitoring what potentially could be impacting our investment case on why this is a quality company. And I think quality is something that I'll probably talk about too much today, because it's really something that we really focus on. But quality is a word that's used quite a lot. And I think
we all hear quality over quantity with most things in our lives.
Exactly. But I think it's really important to ask the question of, well, why is it? Is it important to be investing in quality companies, or we would say our definition of quality companies? And that's because when you're thinking about a quality company, you have greater certainty about its ability to earn returns into the future. Now, as you can imagine, you'd be willing to pay more. You should have more stability in a company where you've got greater certainty about their ability to earn returns into the future. These companies are more likely to compound. So that means that they're high returning companies, that they take their free cash flows, they reinvest in their business to then generate you, the shareholder, that compounded attractive return. And then if you're quality, you can keep investing through the cycle. You have the ability to take advantage of market dips and market highs, which then will lead to a stronger company that comes out of the cycle, whereas lower quality companies could be struggling at different points in the cycle. So we think it's a really important attribute to be looking for in investing.
You mentioned before with quality, there's a whole range of different things you look at, like competitive advantage. Are you able to break a few of those down for us so that if we're looking at a company, we can kind of try and spot them?
Yeah, no, absolutely. So there are many different attributes that you can be looking for. So I think Microsoft, great example of a high quality company. So Microsoft, most of us know them for their productivity suite in Office. So it has extreme scale when it comes to that software. Pretty much all of us use it on a day-to-day basis. It's embedded in our workflows, be it personally at university or also in the office. It also has it's one of the leading players in Azure, which is a cloud offering. So what we have here is two really strong products that it has really strong industry structure. So in the case of the productivity suite, you could call it a monopoly. In the case of cloud, it's operating an oligopoly. It also has scale. They're the largest in the fields that it plays in. It has high barriers to entry. So to recreate what it's done with Office is going to take a significant investment from a competitor to try and eat some of the economics that Microsoft has within its productivity suite. And not only does it need to invest to have a good product, but it needs to be a better product to encourage people to switch, because the switching costs for us as individuals, we know how to use Office. We've been using it, I think, probably since we've 10 years old, probably even younger now. And so for us to switch that muscle memory onto a new product, it's got to be better. And Microsoft just keeps innovating so that we want to keep using their products. So there's some of the things to be looking for, like what is the barrier to entry? Is it high? Is it low? Does it have a strong brand? What's the scale advantages of this business? What does the competitive landscape look like? So it's really interesting reading. So it's looking at the companies, looking at the peers, and then looking at the industry structure, and also what the kind of future direction of a particular industry is going in. Is it a growth industry like cloud is? And then on the flip side, you had a company like Kodak that was focused on cameras, but then wasn't necessarily doing the innovation to understand, well, where was the world going? We all now have a camera in our pocket on our phone, which has made that business not necessarily a forward-looking business for what it was.
Yeah, it's quite funny. I was at a party the other day and they had the Kodak printed cameras with the disposables, but it was certainly a novelty. It's not something that you see all the time anymore. Is this similar to the idea of an investment moat? Because we've had a few guests on the past talk about the concept of having a castle and a moat to defend your company.
Yeah, no, absolutely. That's the exact term that we use internally. It's one of our 6 quality factors that we do all of our research on. And it's what we were just speaking about in Microsoft and what those attributes are. That's really what creates the moat of that business. So we're looking for a wide and a deep moat. And that's what Microsoft, all those attributes that we were talking about, that it's very hard for anyone to come in and compete with that business. And importantly, it's having that view on management. And how is management continuing to innovate to protect that moat? It's one thing if you've had a moat in the past, but if you're not being forward-looking and you can't protect it, then you're not going to be able to continue to earn those really attractive returns into the future.
What sort of questions would you be asking management to see if they're on the ball and thinking about the future and not going to be like Blockbuster when Netflix came along? Yeah,
so it's really important that we, as investors, read widely, because you need to be kind of thinking about, well, what trend could be disrupting the business? And then you are asking management those exact questions. So if something happens in a result, for example, where the company did underperform, we ask ourselves the question, then we talk to management to really tease out, was that just a cyclical issue? Or is there something structurally going wrong in the business that could be leading it to some form of destruction of the economic moat? Now, as you can imagine, companies are always going to say, no, it was just a one-off black swan event. And so when it's something that we view is material, we'll then talk to industry and try and understand whether or not we think it could be that just cyclical element, or is it a structural change in this business?
Now, you mentioned underperforming, and that's quite interesting because I often hear on the news, this company underperformed analyst expectations. Can you break that jargon down for us?
Yes. So if someone's saying it's underperforming expectations, so sitting alongside the funds management industry is an industry called sell side. And so sell side, their role as brokers is to come up with forecasts, and they're publicly available to the industry. And that's really determining, well, what is the market expecting for a particular stock? So we do our own modelling internally, so we'll have our own expectation of what the company should be doing. But that really then becomes an anchor, and that prices are based off, well, what is the market expecting? So if you do underperform, then you're likely to see that share price reaction to the downside, whereas if you outperform on revenue or your earnings, that would lead to an upwards review. But again, it really depends on the share price reaction. Does the market think it is something that is structural change, or is it just like a smaller issue, and how quickly that could correct?
Okay, that's really interesting. Something else I wanted to discuss, because there are just so many companies globally, like thousands and thousands, probably tens of thousands. I don't know. I haven't looked at most of the markets outside of the US and Australia. How do you look at that and then turn that into something useful for your research? Because there's just so many. I imagine most people listening would just look at the list of companies globally, get overwhelmed and just go, it's too hard.
Yeah. Oh, look, it's not easy starting with a blank canvas because you've got well over like 3,000 listed companies that you need to make the decision for. So we will do a filter on liquidity, because as a larger manager, having the ability to enter and exit positions is really important. So we do have a filter on that. But then the next layer is that quality research. So there's no kind of quick answer I can give you on how to determine what to invest in. It's really doing that deep work, understanding what makes this company tick and how it will continue to generate these excess returns. But I suppose some of the things you can look for is, and it's really an outcome of how we're thinking about quality, is that defensibility of earnings, and then is there a structural tailwind that this company could benefit from? And so you just ask yourself those questions of, well, think about the quality, like we already discussed. Like, is it does it have a strong industry structure? Like, how do I use this product? Is this a product essential for me? Because then it could be like an essential product like Microsoft Office to millions of other people as well. So it's really just having those thoughts of, is it quality? And then, well, what industry does this play in? Is there going to be that structural growth for that business for years to come? So like Visa and MasterCard, we've had them in the portfolio for over a decade. Really high quality companies. And we had that conviction in the ability for these businesses to keep growing because of that cash digitization tailwind. Now, just because the tailwind exists doesn't mean every payments company is quality. There's a whole bunch out there that have failed, right? But it's doing the work on, is it quality? So it was a really strong industry structure. What does the industry look like? Why is this going to be successful? The network effect. That means that every player on that network benefits as the network grows. So having that as the base plus that structural tailwind, it meant that they were going from just personal consumption growth and spending to the digitization tailwind and then the e-commerce tailwind, that they've been able to generate revenues in the low double digits, then earnings in the close to the mid-teens for over a decade. Really attractive businesses. So there's a few things you can look at to try and break that down and really just play in your circle of competence. Like, if you don't understand an industry, then just leave it to the side. Like, just focus on what you can really understand to make the investment decision.
What would you say your circle of competence is? I've
been in covering financial stocks for well over a decade now. So I think that would be the true niche and strength of the knowledge that I have. But then the more you keep looking at companies, your circle of competence continues to grow, because you'll start to kind of get a feeling for, well, how do I look at a management team? And so then you could read a newspaper article where you're really impressed by perhaps a management team, and then you do a little bit more work, and it could be in a completely different industry, and you'll see that there are similarities in what you're looking for in companies. But if you like pharmaceuticals, for example, often industry people aren't as familiar with. If it's all about that next big bang drug that comes out, like, if you don't have the ability to predict that or know the tech cycle in pharma, then it's probably not the best place to play. But if you can be thinking about industries like tech and Microsoft, it's a company that you could maybe can get your head around, then definitely do the work.
For some people, they're probably thinking right now going, I don't really know what my circle of competence is. Maybe I've worked in an office job, but it doesn't really relate to any specific industry. How would you start to build out your skill set so you can look at different companies?
Yeah, I think always start with what you're interested in. Mm-hmm. So that would be just opening up the newspaper and read a bit of each of the different sections. And if you're really finding yourself liking reading about a particular industry, then just kind of go down that rabbit hole. And then if that doesn't work out, then go down the next one. Like this, the whole role of investing is just that intellectual curiosity. Just keep reading and learning because that will help you piece together the puzzles.
Sometimes people say, start with a company that you use,
the
product of
absolutely.
Yourself. Do you think that helps?
Yeah, definitely. Because it becomes more relatable and you can really understand how that business ticks because you know how you use that product in your everyday life. And I'd highly recommend like managers, like Magellan does this. We write stock stories, for example, at least on a quarterly basis where we're kind of unpacking, well, what makes this company tick? Why is it that we like it? And so that can be a nice little cheat sheet on how to think about investing is just reading those stock stories and market commentary that comes from fund managers.
Yeah, and it's a great process just to write down why you're interested in something and the reasons why you're buying it before you buy it. We often encourage our listeners to actually have a plan when it comes to their investing and not just take a stock tip from their friend and invest straight away. Actually slow it down. What's the average time frame between you finding out about a company, doing the research before you would invest in it?
So we're really long-term holders in our portfolio. So we typically hold a stock for 3 to 5 years. So we're often just picking from our approved list versus this is a new idea, it's a new stock that's come onto our approved list and then it would enter straight away. Like these are companies that we really live and breathe and have been investing in for on and off for decades. But in terms of the initial due diligence, it can be kind of 1 month of research all the way up to 6 months of research to really get our head around what are the opportunities, why is it quality, and like what are the material risks. Like we're all about what we call downside protection, and that's just managing the potential risks to the business. So we want to know them inside out, and we're happy to spend more time understanding the risks versus just making a decision without really knowing what we're getting into.
How deep's the research? Like, do you fly out to visit the company? Do you test their products? Like, how far do you go?
All of the above.
Yep.
Yeah. So there's a lot of research that we do from our desktop. We're in a really privileged position that there's so much information now available that like company disclosure has really expanded over the last decade. So we can do a lot from our desktop looking at what companies publish. We talk to industry experts. We talk to peers. We can go and meet the companies overseas. That's most of the companies that we're doing, but we're really lucky now with teams that we can actually get access to management from our own home as well, which is great, and it makes a huge difference being able to really question management about some of their strategies and decisions that have been made in the past, and then how they're thinking about the future. It just brings everything off the page to give us more confidence in the decisions that we're making in the portfolio.
So technology is helping you be a better investor.
Oh, absolutely. Absolutely. Though on the flip side, there's so much news. So you really need to learn to read through the noise that can come through. So in some of the companies I cover, you wake up in the morning and you're just like, wow, 200 emails here. And you go through, it's pretty much all noise.
Yeah.
Not all news is necessarily going to be impacting that company. So the more you get to know it, the more you can really kind of read between, well, what's noise and what will actually be potentially impacting the company just on that short-term more momentum noise, or what could be kind of long-term positive, long-term negative.
And that's one of the biggest challenges new investors face, is just working out what's important and what's not. And that takes, is it just time and practice? Yeah, time and practice,
and just also reflecting. I would always encourage people to just have as much self-awareness as you can. And I think the point you made earlier, Kate, was writing down, well, why is it that I'm investing in this company? Because if it doesn't go well, then you've learnt something. You're not always going to make the right decisions. We don't always make the right decisions, but it's learning from them that will then mean that you're more likely to make a better decision in the future.
Yeah. So not repeating the exact same mistake, making new mistakes in the future. Now, I wanted to talk to you about some of the companies in your portfolio, and you kindly brought along some product examples because we were going to dive into Nestle, I believe.
Yes. Yeah. So Nestle is a company that we have covered, I think, for well over 15 years, and we've been invested in, I believe it's for over a decade. So
it's quite a long time.
It's a really long time. Nestle is what we would call our quality defensive company. So I mentioned before, looking potentially for structural growth as a way to look at whether a company is quality, but being defensive is also really important as well, because remember back to that definition of what makes a quality company, it's that ability to see into the future. And when you have a high quality defensive, we've got a lot of certainty around the future earnings of Nestle, because it's really strong with its industry structure.
Yeah.
Okay, so Nestle, I imagine many have heard of it, probably because of chocolate or coffee, but it is one of the largest, or it is the largest consumer staples company in the world. Right. So it has incredible scale, one of those quality points that we mentioned before. It has over 2,000 brands. It's in over 180 countries. But just because it has brands doesn't mean that it's going to be a high quality company. It needs to have scale, which we mentioned when it's got that number of brands in the countries that it's in. But importantly, it's that quality of brand that Nestle has. So it has over 30 brands that generate more than $1 billion in revenue every year. And it's also the number 1 or number 2 brand in 7 of the top 10 growing food and beverage categories in the world. Okay, so all of that is really important because it's a competitive market. Like you think about yourself when you go into the supermarket.
So much choice.
There's so much choice across all of the brands that Nestle is competing with, be it in chocolate, be it in pet food or Maggi noodles. There's a lot of competition.
Is Nestle in pet food?
Yeah.
Oh my gosh.
Yes.
You
Yeah.
wouldn't even know from the surface, would you?
No. So that's a really important part is that breadth, because those distribution relationships that it has means that it's got a lot of negotiating power when it comes to working with the supermarkets and its distributors, which is a really important part of that, what we're looking for in a quality company. Because if you've got such scale, you'll then be able to get your products on the shelves in a timely manner, and then you'll also be able to have some level of pricing power. Now, as we've gone through this period of high inflation, that's been a really important element for Nestle, that they're able to reprice, and then that means the margins of the business aren't too heavily impacted because they could take some of that price back. Now, being a large player with scale enables you to do that. So some of the things we've talked about so far with Nestle and then with companies and what makes them quality, it's that ability to keep protecting their moat. And the scale that they have then means that they can keep innovating. Now, that's how you bring freshness to a brand. Now, that means you have better operating leverage, you have cost advantages over those smaller peers. So if you can keep doing that, and we're very confident in Nestle's management team from our engagement with them and then how they execute on their strategy, it gives us confidence then in those future cash flows. It's also how they're investing in sustainability, which is a really important risk and opportunity within the consumer staples space.
Yeah, especially just transporting their goods all over the world.
Yes.
How do they do that?
Yeah, no, it's really important. There's so many things that they need to be thinking about. So I think some of the things we've talked about, right?
2,000 companies.
Yeah. So the Kit Kat. Yep. Now, everyone would think, I've not been eating Kit Kat for years. You probably don't know it's been around since 1935, right? So very old established brand. But when you think about Kit Kat, I think most don't think about it as this old, stodgy old brand. It's actually a brand that we all love, and everyone grows up thinking that this is a really great product. Why is that? Because they continue to innovate, and because of the scale and presence that they have in distribution, they then get into the store. So the original Kit Kat,
the OG. Yeah.
All right. They then, these are just some examples of the innovation. We've got the chunky with Milo and then hazelnut. Now, what that does is just bring freshness to the brand. It means that when you go to the store, you're like, I like Kit Kat, I haven't tried that. You grab that, and it keeps you within that Nestle, that circle.
Yeah, and I think a few years ago they had a Kit Kat DIY in Melbourne Central.
Yes,
and that you could go and make it and choose what goes in, and encourage you to gift it to people.
Yes, so it's a really important part of just that brand innovation, brand freshness, to keep people thinking about your products. Now, the other thing that Nestle do really well is a concept called good, better, best. So that means that they're able to engage with their consumer across all different income levels and that consumer journey. So as your wealth increases, you can still keep going within Nestle in the good, better, best.
Captured.
As the market turns and you perhaps, I need to not spend as much at the moment, you can then go down that circle. And so coffee is an example where they do that really, really well. So you've got your Nescafe, which is kind of your entry level.
Classic.
Yeah. They've then partnered with Starbucks, which is that higher level of the instant coffee. And then what they've done exceptionally well is that at home, appealing to the coffee connoisseur through the Nespresso pods with single origin, for example. So it's really engaging with the consumer, understanding what their needs are, being nimble, and because of their scale, their ability to invest in R&D, they're able to do that and keep their audience as part of like captive, essentially.
Yeah, that's very interesting, because if I want to reduce costs, I will just use my pod machine at home instead of going out.
Yeah. No, so they've done a really good job at kind of innovating new products within their circle of competence, acquiring businesses that could then fit into their distribution network. So highly defensible company with quality earnings. The industry structure is really positive for Nestle. It's that number 1 and 2 brand is a really important part of the architecture on the the shelf, essentially, that you can't have too many different options, and that the fact that you are the top means that you'll get more shelf presence. So we have a lot of conviction in Nestle's future earnings. It's their scale, it's their brand, it's defensibility of earnings, pricing power, and that focus on ESG and the investment that they're making in packaging. Really high quality company.
Yeah, I guess looking on the flip side, is there anything they can't do? Are there any risks to be aware of? Because we talk about that a lot in investing.
Yeah, so risks for Nestle, in terms of predicting cash flows, we have a lot of knowledge on where that will go. It's kind of that GDP style growth. It's the managing of costs is something that we have to be really cognizant on for a company like this, given their large manufacturing facilities. And it's that timing on how they're able to pass on the price. And so there was a bit of uncertainty in that coming through COVID, because you can't, just because costs went up, you can't go straight to Coles and Woolies, I need to increase the price. There's a timing and a cycle to pass that through. And so that is a risk for these businesses and their ability to price, to reprice. And that's the focus on quality is really important here for the likes of Nestle, because the cost base is there and you need to be able to recoup some of that in periods of higher inflation.
How did you get your head around all 2,000 brands, or do you just focus on those biggest revenue earners?
Definitely focus on the bigger revenue earners, but then it's also just that broader strategy in how Nestle is operating. But our team that covers our consumer and franchises, they are all over it, and they'll be, I think Tracy would be speaking to you for many hours about the opportunities within the company.
Amazing. And just thinking more broadly, in your role managing a portfolio, how do you think about risk? Because it's something I think about quite a bit, of how do I mitigate and minimize risk in different areas of my life and my investments? Yeah, it's a really important part of our investment process. So one of my roles at Magellan is I'm the portfolio manager of our core strategy. So within those strategies, we have a different way of managing risk than what perhaps the active managers are doing. But a big part of it is really coming down to that universe selection. So when we're thinking about what makes a quality company, some of those 6 factors that we're looking at, 2 of those are related primarily to risk. So we call that business risk. And so that's looking at, well, what is the risk to predicting future cash flows, and then also agency risk. So we're already thinking about it in terms of what stocks we will be investing in. So that means we often exclude companies that are more speculative in nature or that deep value, because we want to have that certainty in cash flow. So if we don't have that, they're not in the universe. So I think that's a really important part, and that's that circle of competence we were talking about earlier. Diversification. It's a really important part of managing risk. So in these funds, for example, we have around 80 stocks in the portfolio, which is quite diverse. Not saying if in your own portfolio to have 80, that's going to be, you have a lot of work on your hands. I feel like that's something you do as a profession, not an individual. Yes. But it's thinking then about, well, what different sectors am I investing in to make sure you have that diversification by sector within the portfolio. And then as part of the rules-based approach that we have, we're looking at, well, what's our exposure by geography, what's the exposure by sector, and then the individual stock holding level as well. So it's making sure that you have this balance of risk within the portfolio, so that you're not taking on too much within any particular different sector or stock exposure. Yeah, I think that's good for us to just think of as individual investors. We probably are not going to have 80 companies in our portfolio, because we don't have a team to stay on top of them every day. But just when we're building our portfolio, how are we investing in different things? So we're not putting all of our money into one single company. Yes, absolutely. And as an investor, you've done many different things over the years. You've looked at lots of different companies. Is there any skills that you have that have really helped you become a better investor? Yeah, I think resilience is probably the one that definitely makes you a better investor, because markets are tough. Like we've had the ones that we remember the most, that were the winners, but then the ones that we learn from are those where we didn't make the right call. And resilience is a really important part of that, is just learning from not necessarily our mistakes. If we've done the work, then that's fine, but learning from
like what could we do better as part of that. And it's just keep staying motivated and don't be put off by that good or bad call. It's learning from that will then really just make you a better investor, and I think just a better human.
I like
more
that
philosophical.
No, resilience is an important skill. And if someone came up to you right now and wanted some tips because they're just starting investing, what would you suggest?
I would say to listen and to be curious. I think that's such an important part of being an investor. You can learn a lot from listening and just ask questions. Like, don't be afraid. Like, if you're at a party and you don't know many people, just talk to them, ask them about what they do, and just getting to know a person, their career, their role. Like, that's really important, and you can take that back into your investing. You'll always learn from talking to people. So when you're reading the paper, maybe hopefully you've got some friends that like investing, and just really just discuss different market events to learn, because that will then hopefully will translate into how you're thinking about what stocks to be earning at a particular time.
Yeah, and that's the great thing about technology now. There's groups online and there's podcasts, and a lot of the fund managers, including yourself, have podcasts that are talking about different companies and things. So you can actually learn it from the experts themselves. Well, Elisa, thank you so much for coming on the show today. We've talked about everything from narrowing down our investment universe, how you define quality companies, and got a little insight into why Nestle has been such a long-held company in the Magellan portfolios. Is there anything you wanted to add before we wrapped up today?
No, I think that was a great conversation. I just would always encourage people to keep reading, be curious, just look at different fund managers, because that's a good way to learn as well. There are different strategies out there, and just look at invest in what's true to you. If you want to be more risk averse, then there are managers that will invest in that way. So, yeah.
Amazing. Well, Elisa, thank you so much for coming in the studio today.
Thanks, Kate. It was great to chat.